I want you to picture the room first. The White House. Nearly 20 of America's most powerful oil executives, and a promise that sounds almost cinematic in its scale. $100 billion. Not government money. Their money. President Trump looks at these executives and offers something markets rarely trust, but politicians often sell: total safety and total security. In return, he asks them to rebuild Venezuela's shattered oil industry, and in doing so, bend global oil prices downward to $50 a barrel. On paper, it sounds bold, even elegant. Lower energy prices, relief for American consumers, strategic leverage over a broken petrostate. But history has a long memory, and oil executives, unlike politicians, price memory into risk. They have already lost billions there. They have been burned twice. So here's the real question, and it's one worth pausing on. Can political power override economic reality? If this kind of analysis helps you see what headlines hide, stay with me. Because to understand this moment, we have to step back and look at how we got here. Let me clarify what is actually being proposed here, stripped of spectacle. This is not a humanitarian plan. It is not foreign aid. And it is not a traditional energy investment. It is a wager that state power can substitute for institutional trust. The White House is asking private oil companies to inject roughly $100 billion into a country whose legal system, commercial framework, and political stability have already erased billions in shareholder value. In exchange, the government offers protection, vaguely defined, largely unenforceable, and explicitly acknowledged as incomplete. The mechanism is simple: increase Venezuelan production, flood supply, drive prices down to $50 a barrel, ease costs at home, gain leverage abroad, but the risk is asymmetric. If prices fall, politicians claim victory. If Venezuela collapses again, corporations absorb the loss. And beneath it all sits a deeper question. What happens when markets no longer believe the guarantees of power? To answer that, we have to look backward to the system that made Venezuela uninvestable in the first place. To understand why Venezuela inspires fear rather than confidence, you have to understand how economic systems break slowly, then all at once. Venezuela was not always a warning sign. It sat atop the world's largest proven oil reserves. For decades, oil revenue masked deeper structural decay. When prices were high, institutions weakened quietly. When prices fell, the weaknesses were exposed violently. The mechanism was classic. Political control replaced legal certainty. Contracts became conditional. Profit depended on proximity to power, not productivity. Foreign companies learned this lesson the hard way. Assets were nationalized, rules were rewritten, capital fled. What remained was an energy sector hollowed out by mismanagement and distrust. This is how countries become uninvestable, not because resources disappear, but because predictability does. So when executives say Venezuela today cannot absorb capital, they are not making a political statement. They are describing a cycle, one where history has already assigned probabilities, and they are not favorable. And that brings us to the first rupture, the moment when theory collided with reality. Because systems rarely fail in silence. The rupture came not with a crisis abroad, but with candor at home. Inside the White House, the illusion cracked. When ExxonMobil's CEO Darren Woods spoke, he didn't hedge, he didn't flatter. He used the word markets reserve for only the most extreme cases. Uninvestable, not risky, not challenging, uninvestable. He reminded the room that this would not be a first attempt, or even a second. Re-entering Venezuela, he said, would mean confronting the same legal voids, the same commercial fragility, the same political uncertainty that had already erased billions. And when asked what protections would exist if the country destabilized again, the answer was stark. The companies know the risks. That moment matters because it reveals the fault line. Political leaders think in terms of leverage and timelines. Corporations think in terms of enforceability and loss. One side promises safety. The other asks how it would actually work. If you're finding this tension, familiar power versus credibility, that's because it's becoming a pattern, not an exception. Stay with me. Because beneath this exchange lies a deeper system at work, one that explains why guarantees without mechanisms so often fail. What sits beneath all of this is an invisible architecture, and it's where these grand plans usually break. Markets do not respond to promises. They respond to systems. The hidden mechanism here is the assumption that state protection can replace rule of law. That military power, diplomatic pressure, or political oversight can compensate for weak courts, shifting regulations, and contested sovereignty. But oil investment is not short-term. It locks capital in place for decades. Pipelines cannot move, refineries cannot flee. Once the money is sunk, leverage reverses. That is why executives keep returning to the same words: legal framework, commercial framework, enforceability. These are not abstractions. They are the difference between profit and confiscation. Trump's proposal adds another layer of risk, routing oil revenues into accounts controlled by the US government. From a geopolitical perspective, that creates leverage. From an investor's perspective, it introduces uncertainty about ownership, governance, and exit. This is how economic plans become geopolitical experiments, and why private capital hesitates to be the test subject. And that hesitation sets the stage for a second escalation, one that expands this logic far beyond Venezuela. The second escalation didn't come quietly. It came wrapped in confidence and in warning. In the same breath that President Trump spoke about Venezuela, he spoke about something else entirely: territory, Greenland, a self-governing land tied to Denmark, a NATO ally. And he framed it not as diplomacy, but as necessity. If the United States doesn't take it, he warned, China or Russia will. The easy way or the hard way? That phrase matters, because it signals a worldview where economic assets, energy reserves, and geography are no longer negotiated, they are secured, where sovereignty becomes conditional and power defines legitimacy. Seen through that lens, Venezuela is not an exception. It is a prototype. Control the oil, control the revenue, extend influence over governance. For markets, this is destabilizing. Capital depends on borders meaning something, on contracts surviving elections, on alliances holding under pressure. When those assumptions weaken, risk doesn't rise gradually. It spikes, and suddenly a plan meant to lower oil prices exposes something larger, a shift from rules to force, from institutions to impulse. Which brings us to the people most affected by this transformation, not executives, not politicians, but ordinary citizens caught in between. If you are watching this from afar, this can all feel abstract. Billions of dollars, oil barrels, power plays between nations. But if you are living inside the consequences, nothing about this is abstract. You are the Venezuelan worker promised opportunity, yet haunted by collapse. You are the American consumer told prices will fall someday if this gamble works. You are the citizen asked to trust that power will act wisely even when history says otherwise. This is where grand strategy meets everyday life. When systems fail, people don't experience volatility. They experience empty shelves, lost savings, uncertainty that never switches off. And when leaders speak of security without explaining mechanisms, the burden shifts quietly to you, the worker, the taxpayer, the family planning next year with incomplete information. If this resonates, pause for a moment. Share this, because understanding how power moves before it lands on your life is no longer optional, it's a form of self-defense. And the story doesn't stop at national borders, because the shock waves of this approach, whether it succeeds or fails, will travel far beyond Venezuela and Washington. What happens next is not contained by geography. Oil is a global system. Change supply in one place and pressure shifts everywhere. If Venezuelan production were suddenly revived under US oversight, prices would not just fall for American drivers, they would reshape budgets in exporting nations, destabilize fragile producers, and force recalculations from the Middle East to Africa to Eastern Europe. But the signal matters as much as the barrels. Routing a sovereign nation's oil revenue through another government sends a message that power can override ownership, that political alignment may determine economic survival. Allies take note. Rivals prepare responses. Smaller states grow anxious. This is why international institutions reacted sharply, not because oil markets can't adapt, but because precedents travel once established. They rarely stay isolated. And layered on top of this is the Greenland warning, a reminder that strategic assets are now spoken of openly as prizes in a zero-sum contest. When geopolitics adopts the language of acquisition, markets stop assuming stability. They start pricing fear. And that fear feeds into the final question, not what will happen next week, but what kind of future this logic creates. So let's look forward not with prediction, but with structure. There are three futures embedded in this moment. The first is the best case scenario. Investment flows, Venezuelan production rises, prices fall toward that $50 mark, consumers feel relief, the gamble appears justified. But even here, success depends on something fragile: sustained political control and disciplined restraint. The system works only as long as power remains coherent. The second is the middle path, the most likely one. Capital hesitates, partial investments arrive, production inches upward but never transforms, prices wobble, legal uncertainty persists. The plan neither collapses nor succeeds. It becomes another frozen conflict between ambition and reality. Then there is the worst case. Instability returns, governance fractures, capital is trapped, losses mount, and the precedent that sovereignty and contracts bend under pressure spreads. Markets react not just to Venezuela, but to the signal it sends about the future of global order. These are not forecasts. They are system outcomes, and systems, once set in motion, rarely stop where their designers intend. Which brings us to the final insight, the one that ties power, markets, and people together. Here is the insight that matters most. Power can move markets in the short term, but only trust sustains them. What this moment reveals is not just a debate over oil or Venezuela or even global prices. It reveals a deeper tension between control and credibility, between the ability to act and the ability to be believed. When governments promise safety without mechanisms, markets hesitate. When sovereignty becomes conditional, risk spreads. And when history is ignored, it returns usually with interest. This is not an argument for inaction. It is an argument for memory, for institutions that outlive leaders, for systems that protect people long after speeches end. If you want to understand where global power is moving and how it may shape your life, stay engaged, subscribe. Share this conversation, and watch what happens when ambition outruns architecture. Because the next chapter of this story won't be written in press rooms. It will be written in outcomes,